Rivian Automotive, trading under the ticker Rivian, is currently priced around $12.30 per share. The stock is down approximately 7% year-to-date and about 15% over the past 12 months. Despite recent volatility, Rivian has been a focal point of interest for investors due to its innovative electric vehicle lineup and recent strategic developments. In the first quarter of 2025, Rivian reported revenue of approximately $1,240 million, which marked a 3% increase year over year and surpassed Wall Street estimates by nearly 24%. The company reported an adjusted earnings per share of -48 cents, significantly beating analyst expectations of -92 cents. Rivian also reported gross profit for the quarter of $206 million, marking the second consecutive quarter of positive gross profit. Despite this, the company still posted a significant operating loss. For full year 2024, the operating loss was approximately $4,690 million, with gross profit reaching just over $1,200 million, offset by over $3,490 million in operating expenses. The company's free cash flow remains negative, with a trailing 12-month levered cash flow of -$1,400 million and unlevered cash flow around -$1,200 million. Looking ahead to the second quarter of 2025, Rivian is expected to report revenue of approximately $1,290 million, compared to $1,160 million in the same quarter last year. Estimated earnings per share are projected to be -66 cents, showing an improvement from -$1.26 year over year. However, vehicle deliveries in the second quarter were 10,661 units, down from 13,790 a year earlier, a decrease of 22%. Production also declined significantly, with just 5,979 vehicles produced compared to over 9,600 in the prior year quarter. This drop in volume aligns with the company's plans to retool its production lines for upcoming next-generation vehicles. Rivian continues to face significant margin pressures, especially due to new tariffs on battery components. Although the company manufactures its vehicles in the United States, it is still affected by Trump-era tariffs on imported battery cells, which has prompted a revision to its full-year 2025 delivery forecast. Rivian now expects to deliver between 40,000 and 46,000 vehicles this year, down from previous guidance of 46,000 to 51,000. Capital expenditures have also been revised upward, now expected to reach between $1,800 million and $1,900 million, compared to earlier estimates of $1.6 to $1.7 billion. These higher costs are necessary to address tariff-related expenses, expand plant capacity, and prepare for the launch of its upcoming R2 model. Despite these challenges, the company is maintaining its forecasted adjusted EBITDA loss of between $1,700 million and $1,900 million for the full year. One of Rivian's most promising developments is its strategic partnership with Volkswagen. In June 2025, Volkswagen made a $1 billion equity investment into Rivian and committed to a total of $5 billion in funding by 2026. This partnership includes the creation of a joint venture called Rivian and Volkswagen Group Technologies, aimed at developing scalable software-defined vehicle platforms. The collaboration is expected to enable both companies to reduce development costs and accelerate the rollout of next-generation vehicle technologies. Rivian's proven strength in vehicle software and its vertically integrated platform make it an attractive partner for Volkswagen, and the joint venture could become a key revenue and efficiency driver over the next several years. Another major catalyst for Rivian is the upcoming R2 SUV, which was unveiled in March 2024. Priced under $50,000, the R2 targets the mid-range EV market and marks Rivian's first attempt to scale globally, with plans to sell in Europe and North America. Production is scheduled to begin in 2026 at the company's existing plant in Normal, Illinois. In addition to the R2, Rivian has also opened up orders for its electric commercial vans to third-party fleet operators, broadening its revenue streams beyond consumer markets and Amazon's exclusive deal. Despite the upside potential, there are still considerable risks. One of the most pressing is the ongoing manufacturing volatility. As previously mentioned, vehicle production and delivery volumes fell sharply in the second quarter due to retooling efforts, and this trend may continue to affect near-term performance. Additionally, Rivian remains heavily dependent on external funding. The company had approximately $5.3 billion in cash and equivalents at the end of 2024. But it also had about $8.8 billion in total liabilities. Although its cash burn has slowed, dropping to negative $526 million in the first quarter from negative $1.5 billion a year earlier, Rivian is still far from achieving profitability and could require additional financing if cash reserves dwindle before the R2 goes to market. There are also macroeconomic headwinds to consider. The potential elimination of the $7,500 electric vehicle tax credit in the United States could reduce consumer demand, especially for higher-priced models. While Rivian previously used leasing arrangements to ensure customers still qualified for the tax credit, regulatory changes could impact this workaround and reduce competitiveness. Furthermore, the global economic environment remains uncertain, which could affect both consumer spending and commodity pricing, in turn impacting Rivian's supply chain and input costs. From an investment standpoint, Rivian presents a mix of promise and peril. On the bullish side, the company has demonstrated improving gross margin trends and has formed a high-value partnership with one of the world's largest automotive manufacturers. Its expanding product line, including the R2 and the new commercial van offerings, shows potential to scale both consumer and commercial markets. The Volkswagen joint venture in particular may provide Rivian with long-term technological and operational synergies that improve its path to profitability. However, from a bearish perspective, Rivian continues to face steep execution risks. The company's downward revision of its delivery targets, reliance on new capital injections, and vulnerability to regulatory and tariff risks highlight the challenges ahead. The R2 launch, while exciting, is still over a year away from production, and much could change in the competitive EV landscape during that time. The company remains unprofitable, and while its cash burn is improving, it still lacks a clear timeline to break even. Investors should also be wary of dilution risk given Rivian's recurring need to raise capital. Overall, Rivian is an EV stock with strong long-term potential but high near-term uncertainty. For investors with a high risk tolerance and a multi-year investment horizon, Rivian could be a strategic bet on the future of American electric vehicles and automotive software innovation. However, more conservative investors may want to wait for clearer signs of profitability, sustained growth in deliveries, and successful execution of the R2 launch before entering a position.